Good evening, everyone. Good evening and welcome to this video call on SATCO Growth and Momentum PMS. Thank you very much for taking the time out and joining us in a time when there is a flood of webinar invitations to you. We hope to make it worthwhile for your time today. My name is Deepak Jaggi and I head SATCO Wealth Managers, a group company of SATCO Capital Markets. Let me quickly give a brief on today's session. I will give a small brief on SATCO Group and introduction to today's speaker, followed by presentation by our fund manager, Mr. Nitin Raheja. After that, we will open the session for Q&A. SATCO Capital Markets is a SEBI-registered capital and commodity market intermediary. It is member of NSE, BSE, MCX, and NCDEX. We are also a depository participant with CDSL and have PMS registration. Commencing business in 1994, SATCO has strong presence amongst retail, HNI, and NRI clientele. SATCO has over 25,000 registered client base, over 11,000 demat accounts, and over 20 franchisee offices across the country. Our today's speaker is Mr. Nitin Raheja. Nitin is a veteran of the capital markets with over 27 years of experience, of which last 20 years have been in managing funds for mutual funds, family office, and HNI clients. He has worked in established financial entities like Enam Securities, Sun F&C Mutual Fund, and Dawnay AV Financial Services, where he was CIO for their offshore fund and domestic PMS. Nitin is managing SATCO Growth and Momentum PMS since its inception in January 2012 and has done exceedingly well. To talk about past, present, and future of capital markets and specifically of our PMS, I invite Nitin to take over from here. Thank you.
Yeah. Thank you very much, Deepak, for those kind words. And thank you everybody for joining in on this Friday evening, where I'm sure you would all like to be with your family, and doing something with them. But thank you again for your time. So I will try and structure this by telling you a little bit about our PMS, our investment philosophy, how we have done. Also a little bit on the present scenario and how we manage these challenging times which we saw in the last 6 months, and how we emerge from it much more stronger. I will just share the right. So a little bit on the background, as Deepak said, I've had over 28 years of experience in the capital markets. I was a part of Enam and was a part of the team which was involved in taking public notable names in the market, blue chip names which you see today, such as Infosys, Thermax, Marico, etc. And I was then a fund manager with a mutual fund. I used to manage in Sun F&C Mutual Fund. I used to manage the balance fund, the tax saver fund, and the technology fund from 2000 till 2005. Post which, when Dawnay was AV, which was a wealth management company, was being set up, I was one of the first 3 employees, and I was the CIO of the company running the PMS. So I have been really managing money all the way back from 2000 till now, which is almost close to 20 years in my career. The Growth and Momentum PMS with SATCO is something that we've been running from 1st January 2012. And we believe that it is one of the most successful managed PMSs in the present context. If I have to, briefly highlight, for our early investors who entered from 1st Jan 2012, have gained almost 790% plus. That translates into a 28.7% compounded annual return for our investors. And there is a huge outperformance that we have done vis-a-vis the benchmark. As you can see that in this 8.5 years, we have outperformed the benchmark every single year except in 2018, which is when the NBFC crisis hit us, and and as I will explain later, we did have a overweight position in NBFCs, although quality ones, but nevertheless. 2019 we were back, and we were outperforming the index, and then 2020 we've outperformed the index by a huge component as such. A graph which tells you how an investor who would have invested about 1 crore would have seen his wealth multiply almost 8 times during this period of time as such. So what is this growth and momentum PMS that we look at? In very simplistic terms, if I were to tell you, we look at companies who are growing and who are who are doubling their profits every 4 years, which roughly translates into a 19.5% CAGR. It is our belief, and when we started this whole journey, that our Indian markets, if you go back historically, and you had, and I'm sure you people know better, that over a period of time, when you looked at what the Sensex was or the index used to return, everybody used to tell that, well, the long-term returns from equity is 15% CAGR at a point of time a few years back. Now, of course, that number is more like 10, 11%. But so when we started our journey at that point of time, and there was a logic behind this, when we said that if our nominal GDP growth rates at that point of time would be, say, around 13, 14%, with 7, 8% GDP growth and 5, 6% inflation, we said as managers, we should be doing at least a 5 to 6% outperformance, and hence we came to the number of 19.5%, or doubling in 4 years, to put it very simply. So it is a PMS which focuses on high growth companies, because we believe India is a high growth economy. Global investors want to come to India because they see the potential of India as a place where they can grow their businesses really fast. So hence, we believe growth is the key paradigm in our approach. We also follow a mix of a top-down and a bottom-up approach while we are doing this, wherein we are able to identify sectors we think will benefit from this whole growth upturn, as well as certain companies which we think, even in sectors which might not be great or emerging sectors, who will be able to benefit. So, and hence the bottom-up approach. Also, typically portfolio companies are typically, and who are these? So, when you look for companies who are going to double their earnings over 4 years, it's very important to understand that there are very few, commodity-based companies are not going to be there. Most often they're not. But it's very important to understand that only companies whom you and I can see 4 years from now and have visibility on their earnings, which means these companies have to have a very strong long-term competitive edge and capable management to be able to do that. Again, when we talked about why we looked at this 4-year number, as the chart will show you, when we look at companies in the CNX 500, we found there were almost close to 100 companies who actually doubled their earnings over this period of time. And you will see over the last, this data, this is as of 2019. We saw that, as companies doubled earnings in the large cap space, the market cap grew by 1.08 that. Similarly, in mid caps, it was slightly more, and small caps even more. So very clearly, if there is profit growth, market cap will grow. Very clearly, if there is profit growth, these companies will be able to withstand volatility in prices and yet come up winners over this period of time. Again, within this bunch of companies, we further classified it in terms of, how do we look at these companies, and where do these companies emerge from in terms of themes. So we saw there are certain companies who continue to deliver these numbers, and who have been consistent in delivering numbers. We look to buy these companies very often when there is a panic in the market, or when there is a deep correction in the market, and we get them at good prices. So, if you take companies like Bajaj Finserv or a Kotak or an HDFC Bank, they would come under a classification of consistent excellence. They have delivered numbers through cycles, bad, good, ugly, as such. There are companies we find who are typically, addressing large potential market sizes, but currently where penetration is very low. So companies like Weber Global, which is actually a home shopping network, supplying in a very large market like the US and UK, or an SBI Life in the life insurance sector, who has numbers virtually on par to the leader, but trades at a substantial discount. Again, then we also have companies who are moving up in terms of value addition. These are the kind of companies where we find that the appreciation to capital is the maximum, because these companies are growing at the same time improving margins. So it's like a holy grail, if you were to call this. So where we have companies like Granules India, who actually moved from being a pure API manufacturer into formulations, and now into the US markets, all the while focusing on very few core 5 products. Or companies which are driven by policy momentum. Now, when we talk about policy momentum, we are talking of companies who operate in markets which are largely free, but there is an overall policy. So, for example, when we invested in Indraprastha Gas, Delhi was choking under pollution and forcing the Supreme Court and the government to come up with measures to, which would favor alternate fuels on cleaner fuels. So, demand for CNG just, went through the roof after that. So, you take someone like Deepak Nitrite, who is benefited from the fact that, they built up import substitute products and are well placed when the government is talking of Atmanirbhar Bharat, or when corporates are looking at India over China. And then we have corporate actions, which also play out very well in short terms for us. We saw Weber Global when they did a buyback, or even a Dhanuka Agritech, whose buyback is now going on. So if I have to go back, these are some of the companies we own in our portfolio today. And just to give you a flavor in terms of, we've owned some of these companies for very, very long periods of time. So for example, UPL is something that we've been owning from 2013. And we made almost 400% from that initial price till now. Or a Bajaj Finserv from December 2014, or Indraprastha Gas from 2016. Even a Deepak Nitrite we are owning from 2018, and so on and so forth, or a Granules. So these are the kind of companies, and these are the kind of returns that we've earned, all from essentially holding. Of course, very opportunistically, in March, we got into a few companies which actually gave us very, very handsome returns and have contributed to our performance. If you take the past, over the last 7-8 years, the past winners that we have seen have been, again, companies we even own today, but where we possibly got out at some stage when the business went through temporary challenges. So whether it was an APL Apollo, so if you take Granules, our first purchase price was 22 in 2014, and then we got out at 105, and then once again we entered a few years back when the business had overcome the short-term challenges that it faced. In retrospect, we could have probably just held it through all this period and yet made a lot of money. So, the same way is with Weber Global, which we got out and we got back in as such. But the point is that the approach of trying to look at such companies who have been doubling their earnings over four-year periods has resulted in humongous returns for shareholders. For our portfolio clients, and has contributed to the compounded return that you saw. Having said that, one of the key questions that comes about, and most people ask us now, is that fine, all of this is great, but you know what? This is a once in a lifetime event that has happened, the whole COVID crisis. So how should one look at investing in such times, especially when the economy seems to be giving you a completely negative picture? You've had this huge contraction in GDP growth. At the same time, the markets are very, very close to their all-time highs. So we decided to go back to the drawing board and look for history, look into history for such answers. And what we did is we said, let's go back all the way to 2008 and try and identify how the various, identify first, the drawdowns that the markets have seen. And we classified drawdowns as periods when the markets actually from the peak came off more than 20%. We clearly saw that there were 4 drawdowns in this period. So that means if you had invested on 8 Jan 2008 or you were invested in the markets at that time, in this 12-year period, you've seen 4 drawdowns, right? The first one happened in 2008, where there was a 60% fall from peak to trough. The second one happened in close to 2010, 11, where there was a 28% peak to trough correction in the market. This was led by the Eurozone crisis, a slowing global economy, and high interest rates at that time. The third drawdown happened in 2016, where the markets corrected 23%. And the last one is the one we just saw, where there was a 38% correction in markets. Now, having identified these drawdowns, we said, okay, let's look at when these markets came back to their original level, assuming that you were not smart, assuming that you had invested in these markets at close to peak valuations or at the peak of the market. So you were invested in at 8 January 2008 when the markets hit an all-time high of 6288 at that time. And you saw the entire drawdown and it came back to its original level in 5th November 2010. Now, during this period when the markets essentially just came back to their original peak level, we said, let's try and find which are the companies who at least delivered a 15% plus CAGR return for the shareholders through all these periods. And what we found is that through this sample, we took the CNX 500 as our sample. We found that there were at different points of time, if you would see in the first drawdown, there were 101 companies who actually delivered a 15% CAGR. In the second drawdown, there were 63 and then 115 and 112. So on an average, if you were to take almost 100 companies, despite such sharp drawdowns, delivered 15% plus CAGR. Now, this sample of companies actually fell far less than the market. So in the first drawdown, this sample of 101 companies actually fell 46% vis-a-vis 60% in the market. In the second sample, these companies fell 4% versus 28%. In the third, it was actually they grow, they increased 4% when the markets went down 23%. And in the last drawdown, which is the one that we just saw, against a 38% drop, this sample of companies dropped only 26%. However, when the bounce back happened and the markets did bounce back, these companies bounced back with a factor of anywhere to 2x of the market, anywhere from 1.5 to 2x of the market. So you can see that in each of the cases, the bounce back of this sample of companies was 252%, 88%, 50, and 83. Now, through this period, these companies actually gave, when the market was a flat return, a return which was 91%, 81, 56, and 36% respectively. Now, so then we said, okay, let's go down further and try and find out what are the attributes of these companies. One of the key attributes which we found, which again reinforced the belief that we have in our own investment strategy, that these were all high growth companies. In these companies, you can clearly see the PAT growth was close to anywhere between 25 and 30%. So if you see the D1, D2, D3, the average PAT CAGR was close to 30%. In the current one, it's been 22%. More importantly, it was just not profit growth. It was profit growth which was of a high quality. The return on equity of these companies was all close to 20% plus. So very clearly, it only reiterated to us our own investment hypothesis that if we are invested in high growth companies, even if you get the timing wrong, and it is a known fact that most of the time you don't get almost every time you don't get the timing right. Even if you are invested in close to the peak and you are in this quality of companies, you will be okay when the bounce back comes. In fact, you will be more than okay. You would have actually made much more than the market. And let me also tell you one other very key highlight out here. If you thought that, okay, let's wait for the bottom, and when the thing bottoms out and starts rising, then I will invest, you would have missed a major chunk of the bounce back returns. You would have only got back far late, and the numbers that you see out here would not be what they see. So now, given that context, how did we do in our portfolio, and what did we do during this period of time? So as we were going into this period where the COVID cases kept on rising, so if I give you a little background to this, just before we got into this whole COVID, the economy was any which way struggling. Consumption, which had hitherto been one of the big drivers of growth, was struggling. So traditional consumption items were all struggling. Autos were struggling, and so housing was struggling, and so on and so forth. But there was absolute retail-oriented consumption, smaller ticket items which were doing well. So for example, exhibition or theaters were doing well. Retail was doing well. But as we saw COVID cases rising, we preemptively exited some of these sectors that we owned in our portfolio. So, for example, we had Inox Leisure, the second largest exhibitor in the country of movies. We said, look, these are areas that are going to come into problems. Even commercial space, we had a few of them, we got out. So we made changes in our portfolio while we did. So now we didn't see the intensity and velocity of the fall would be so savage and furious. But what we had done preemptively was we had some cash, which was higher than normal as such. We had got out of some of these stocks. But as the full weight of the crisis hit us, we were holding almost close to 30% cash in our portfolios, which was very uncharacteristically high. Another uncharacteristic thing that we did at that point of time is we invested 5% of the portfolio in gold, so using the gold Bs as such. And the reason we did that was because at that point of time, when there was so much of uncertainty all around us, businesses were shutting down, and in PMSs you're not allowed to use derivatives or hedging instruments. We used gold as a hedge at that time, and it was our view at that time that if everything goes to the dogs, gold will help us at that point of time. So we actually added gold into our portfolio. We didn't really honestly think that we would make the kind of money that we made in gold. To us, it was actually a better hold than holding cash. At least, we thought, in a worst case scenario, this would give us returns. What we did also was, at that time, we looked at companies and sectors which we said will be well placed to come back when the lockdown is lifted. So we already had pharmaceuticals in our portfolio. We were holding granules in our portfolio, at that point of time. We added IOL. IOL is something which is one of the largest manufacturers of ibuprofen in the world, an API manufacturer at that, trading at a ridiculous valuation. So we bought in IOL into our portfolio, and we bought JB Chemicals into the portfolio. We found the valuations cheap. It was a domestic manufacturer. It was on the known intent that the promoters were looking to sell their company to a larger entity or a PE firm. Chemicals, we did nothing really. We owned whatever chemicals we had even before this. So whether it was a Deepak Nitrite or whether it was a Fairchem specialty, we added agrochemicals at that time into our portfolio. I mean, we already owned UPL as I mentioned to you earlier, for a very long time, but we bought in Dhanuka because we saw that agriculture is doing exceedingly well based on various conversations that we had and feedback that we got from companies as such. And we bought in telecom into the portfolio, which we didn't have hitherto as such. Gas was something we already owned. So we believe that with this, we had 45% of our portfolio which was hedged against COVID, which would do well, COVID or no COVID. Because we believe that people will yet take their cars out whenever the lockdown is lifted and they use CNG, or even if they're at home, they will use PNG, and so on and so forth. So the 45% of this portfolio was, again, all the characteristics of these companies was they were growing and they had great balance sheets with low levels of debt. In the financial space, which, as I mentioned to you, in 2018, we were at a point almost 35% plus weighted towards financials. Post 2018, we clearly saw the writing on the wall that the NBFC boom is over. That's not to say that NBFCs will die, but we said that there is going to be consolidation. We have been playing the consolidation game in financials from early 2019 onwards. So we restricted ourselves to the top 3 private sector banks and the top 2 NBFCs, because we said at a time when capital is scarce, these are the players who will be able to raise capital or or attract capital at attractive prices and be very competitive vis-a-vis some of the mid and the smaller players. We reduced our allocation to the lending financials to 17% because we yet believe that we are not over the hump. NPAs could surprise, but we believe that among the group, these companies that we own, say for example, in the private sector bank, we own HDFC, ICICI, Kotak, and then we own Bajaj, Finserv, and HDFC in the NBFCs. So if I take that, we think these are companies who have already gone and raised capital and showed up their balance sheets. They will be able to withstand and in fact garner market share at the cost of a lot of others. Besides that, we had a lot of companies who, from a bottom-up perspective, who had very strong earning visibility and business characteristics. Notable among them being companies such as WebHub, companies like IEX or an Apollo Tricoat, or a Dhanuka, like I mentioned to you, or a GMM Pfaudler. So while everybody was playing pharma, when the collapse happened, we saw GMM Pfaudler had halved in March. We went in aggressively and we built in a stake in that, saying that this guy is a leader. If pharma and chemicals has to do well, they have the market share or the leadership in supplying reactors. So we made all those changes in our portfolio. The net result of that was, if I have to show, I will just show you. Yeah. So before that, I will just show you that how did our companies perform in this last quarter when there were serious challenges. Our non-financial group of companies delivered 18% EBITDA and 19% profit growth in the June quarter, which was plagued by lockdowns. Our financials did 15% PAT growth, even in such challenging times. So again, going back to our original thesis, if there is growth, those companies will yet withstand challenging times and in fact come back stronger. And the net result, as you can see, is when the markets corrected 38%, we corrected less. But when the markets bounce back, we bounce back more. So the net result from, if I look at from Jan 1st till now, till 31st August, while the CNX 500 is down 5.1%, we are up 15.2. Clearly a 20% outperformance, which is humongous. All of this has really meant that in the last data which PMS Bazaar put out as of July 31st, and we are awaiting August data now. When I look at multi-cap PMSs who follow model portfolio approach like we do, we were in the top tier, not the top tier, but we were the number one, whether you take it on a 1 month, 3 month basis, 1 year basis, even since inception. And we were number two, whether on a 5 year or a 6 month basis. Similarly, if we were to expand that universe to all multi-cap PMSs, those who use model portfolio and those who use non-model portfolio approach, if I have to call that, on a 1 year basis, we were number 3 out of 93. On a 5 year basis, we were number 2. And since inception, in terms of our performance, we've been number 1. If you look at funds which have been around for 5 years, that means they've seen enough cycles and seasoning. Again, we were in the top 10% out there. On a 1 year basis, we were again number 1. 5 year basis, we were number 2. And since inception, we were number 1. All of this is really testimony to the investment philosophy that we follow and the approach that we follow, where we look for high growth companies with quality management, which has meant that over periods of time, we have continuously delivered numbers. With 2018 again, and I like to remember 2018 very often to myself because it keeps reminding me of the one bad year we had and making me aware that we don't have to repeat that or make that happen again. With this, gentlemen, I am done with my presentation and I